Welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This indeed is the podcast that will make you a smarter investor, and if you could have fun in the process, well, that is all the better. Before I get to our interview of the day on Opening Bid, have to start with our stock of the day. And for me, the stock of the day, get ready, it's UPS, United Parcel Service. Coming in or getting a downgrade over at Barclays. I would say this is a vicious downgrade to underweight. It is not the norm that you see a UPS, which is an iconic company in the U.S. and around the world, slap with an underweight rating, which is the equivalent of a sell. So the team over at Barclays, actually the analyst Brandon Oglensky, citing the potential for a weak freight environment, loss of Amazon volumes. Amazon's about 12% of UPS's business, so a big customer there, and a more efficient FedEx. So those are the reasons or the drivers behind that UPS upgrade. But the bigger picture here, this has been a pretty dreadful year for the team over at UPS. Shares are down 14% year to date. Shares of FedEx up 8% year to date. And a lot of folks on the street have dumped UPS in a show me story bucket. The street has not been happy that the company has taken a more aggressive approach on pricing. They're sucking in more lower margin e-commerce sales, noticeably from Temu. I believe that's a new business for them too. In July, they came out and completely whiffed on earnings, cut the full year revenue guidance by $1.5 billion. So it has been a dreadful year for this company, which is not the norm for UPS. So the street, by and large, is bracing for a potential another warning from UPS when it reports in just a few days. That's my stock of the day, UPS. I should note FedEx on track to cut $4 billion of costs out of its business over the next 12 months. That's why the street has warmed up to FedEx. All right, let's get to a better story, a better stock story here, and that's Nvidia. Bank of America analyst Vivek Arya covers Nvidia very closely, and he joins us now on the pod. Vivek, good to see you in person. Never met you in person. Been talking to you for like 5 years via remote. So thanks for coming down to the NASDAQ.
Ryan.
Yeah, I appreciate it. Yeah, it's so great to see you here at the NASDAQ where we tape Opening Bid. New note out on Nvidia for you, and I'll set it up this way. You call it a generational opportunity. Unpack this for us.
Sure, I think we are in front of a generational opportunity because it's not every day you go and get a chance to re-architect the plumbings, right, of the computing infrastructure. This is what we saw back in the late 80s when the internet started. There was a small movement in the Department of Defense, and then gradually it reached the commercial stage. And every year there were questions about, what are the returns on investment? But what we saw during that nearly 10 to 20 year phase was new business models get created. Amazon came out, Google came out, Meta came out, right? Microsoft changed its entire way of doing business. So with these things, they take place over a period of decades, right? And it's not always apparent in the first 1 or 2 years what shape they're going to take. But what is key to them is that there is a creation of a new computing infrastructure. And what we have learned over time is that the more computing you give to companies, to application developers, to the software industry, the more new business models they are going to create. And I think that's where we are today, that this thing called ChatGPT or OpenAI, I know it seems like it has been with us for a long time, but the application really only came out in November 22.
It does feel like forever.
So, we have only been here for about 2 years. If you look back at when Nvidia started to report their very big quarters, it was May 23. So it's just been a year and a half, and we are trying to predict the peak of this cycle, which is why I think that it's a generational opportunity to re-architect the plumbings of this to something that is far more computational intensive. And my hope is that just like we saw with the prior re-architecting, which gave rise to very important business models, which by the way were not apparent, right? Even in the first decade, I think this thing is going to give rise to something that is similarly equally good and productive, right, for the entire global economy.
Before we get into more of the drivers or behind your call, 190 price target, about, let's say 40% upside from current levels. So a good price target there. Take us through your process. What is it like as an analyst on Wall Street covering the world's most popular stock, if not company?
Sure. Where we spend 90% of our time is interestingly, right, not on valuation per se, because I think that especially with technology stocks, valuation sometimes is a lagging indicator, right? So it's interesting that I mentioned that ChatGPT came out on November 30th, 22. Nvidia was actually trading at a higher multiple that day than it is trading today. So that tells you that when these stocks look the most expensive, what they're really signaling is that their opportunity is getting much bigger and their competitive position is improving. So sometimes it's actually better to buy or better to consider technology stocks that are trading at higher multiples than lower multiples, right? Because these stocks have a way of sniffing out the future, right, if you will. But very specifically, our process is that we still need to have some laws of gravity in place. Nothing goes. So we do 2 to 3 year earnings models, and we come out with an earnings CAGR, and we say that semiconductor companies. So I cover a mix of semiconductor and some design tool software, the EDA companies. And we say that semiconductor companies, they should trade between 1 to 2 times earnings growth in that. So let's say if we do a 3 year earnings model for Nvidia, let's say we are able to come up with a 25% earnings CAGR during that time frame.
Compound annual growth.
Compound annual growth. So in my mind, any time Nvidia's valuation is between 25 times to 50 times, right? The PE multiple has no predictive value. It just tells you it is in the zone.
So Nvidia is just detached from valuation.
Well, not detached from valuation. See, ultimately, the real focus is on making that earnings growth prediction, because that is where we can get a lot of things right, but also a lot of things wrong. So that is where I think the focus has to be, as opposed to saying, 30 is the right multiple or 40 is the right multiple, because that is really the end part, right, of the process. It's not the start of the process to pick a random stock and say, oh, 30 PE is good or better because it's above or below the market. That's not the case, right, at all. Do an earnings CAGR, right, do 1 to 2 times earnings growth. When it is close to 1 time, you can see in the last 5 years, Nvidia has consistently bottomed at about 24, 25 times earnings. That's not an accident, right? Because that is its earnings growth profile. And generally, when it gets to like mid 40s to 50 times, that's when it starts to peak, unless earnings growth right, gets revised upward. So 1 to 2 times, I think it is as easy as that in our approach.
You're not there now, of course. You came out here with a $190 price target. Will a downgrade be one of the toughest decisions that you've ever made in your career? I mean, because this is the world's most popular company.
Right. Yeah, we have we at BFA we have a cluster, right, where we have a certain distribution of buys and neutrals and underperforms. So we follow that, and it's really about trying to say that within our cluster, right, what stocks can outperform, right, the average, what stocks will underperform that average. But no, I agree that with any of these growth stocks, right, whether it is this or Broadcom or AMD or Marvell, that I think some of these companies are right at the epicenter of changing this technology. So my hope is, of course, we want to get these stocks right, because ultimately that's the role, right, that we have. But I hope that we do a better job of making sure that we are getting the theme right. Because I would rather be a little early, right, to a theme than be very late, right, to a theme. So trying to predict these themes early and then just sticking with them, unless either the theme breaks or the execution breaks, right? Then of course we can always revisit our views. But I agree.
Or Jensen retires and moves to an island out there somewhere and enjoys his life. Let's go through some of the drivers behind this. Right now, you have the street is focused, I would argue, on Blackwell. It seems like they've gotten any production issues out of the way. They highlighted that maybe a quarter ago. What do you see over the next 2 quarters in terms of Blackwell demand, and do you think it will really surprise the street like prior iterations of the technology did?
Yeah, so it's interesting that the demand for their Hopper generation is still very good, right? That I remember looking at our forecast for these quarters a year ago, and we were wildly off, because we thought that just when Blackwell starts to roll out, that there would be a dip in the demand for Hoppers, and that's not what is happening. Because the situation today is that everyone is in a race. Everyone is in a race, as in, you have this company called OpenAI that is driving the market in its own very unique private structure, right? And then you have somebody like Meta who is driving the market in a very open structure, right? And then you have a number of the other large companies, right, the so-called cloud companies in between. They have to catch up, right? They have to catch up in terms of these two forces that are pulling them along. And when you look at the state of the art in large language models, that is changing 3 or 4 times a year. So even a 1-year product cadence, you're already too late. right? So it feels like, Moore's law has been this cadence of 18 to 24 months, and sometimes there were question marks on, can we really use that much technology? And here we have even a 1-year product cadence, you're already too late. So as much computing resources that you can throw at these different customers, they are willing to adopt right now, because to them, investing in generative AI is as defensive as it is offensive. We always ask the question, tell me about how much money you're making on this subscription or that subscription with generative AI. How about the fact that they're protecting their moat? If I go to the famous search engine, and let's say if I'm able to see a result using their Gemini, right, large language model, I'm less inclined to go and search for that somewhere else. That is protecting their moat. What is the value of that? Isn't that monetization, right? So that's why I think that these companies are in a race. But to come back to your question on Blackwell, yes, Blackwell just gets started in the current quarter, I think a few $1 billion, as they have suggested in the current quarter. Then I think it starts to build up, and I will not be surprised if in 2 or 3 quarters from now, it is outselling Hopper easily, right? And one reason I think it can also do that is, in the Hopper generation, they were selling essentially boards of about 8 GPUs or so. Here they're able to sell complete rack scale systems, right? Which is the other point with Nvidia, that you can't just look at their sales and compare it to the semiconductor industry addressable market, because they are really a system integrator at this point, right? They're selling complete racks with all the computing, the networking, the optical resources, the memory, everything thrown in. That is why the revenue monetization opportunity is so much greater. And then finally, if they can bundle their software services right on top of that, that is what expands their addressable market.
Vivek, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, having a real fun chat on the world's most popular stock. That is Nvidia. Bank of America analyst Vivek Arya really driving or taking us through his big call on Nvidia, $190 price target, of course, and sees it as a generational opportunity. You were one of the folks, I think, I loved your latest note, really dove deep, and I think a lot of investors on Yahoo Finance that own Nvidia, and there's a lot, they don't know what else is coming. And you laid this out, some new chips. Blackwell Ultra next year, Rubin in the third quarter of 2026, and then Rubin Ultra. What do you know about these chips? What will they do, and who's buying them?
Sure. So, when it comes to semiconductor technology, you always have 3 or 4 different levers that you can pull, right? First is the lever of designing the key logic chip, right? That is the one that is doing all the instructions, right? Second is now getting it closer to memory. So there is innovation on the memory side that Hynix, Micron are bringing to the table. So you bring memory more and more and more memory closer to this chip. So that's your second level. And you hear this term called high bandwidth memory that you're bringing in closer to the chip, and there are new generations of that. Then you have to package it. That's another innovation that companies like Taiwan Semiconductor bring to the table. Then you have innovations on the networking side, where you are going from 50 to 100 gigabit per second to 200 gigabit per second interfaces, because just having something that is super smart is not good enough. You need to connect 30,000, 100,000, 1 million of them together. And then you don't want the things that are connecting them together to be the bottleneck. So that's the fourth place where you have innovation. And then the final place where I think you need to have innovation, just from the semiconductor perspective, right, is to make sure that the software, right, that is able to go and connect these things together, is able to optimize the performance of. That is where Nvidia is unique, right? So people say, oh, you know what, their software can be done by somebody else, or this chip can be done by somebody else, this networking can be done by Broadcom, this memory can be done by somebody. It's like the Apple model, where when you're buying that iPhone, you're buying all of those things in one package. That is something nobody else can do, right? So that's why I think that every year what you will see is them innovating in a subset of these different drivers. So one year it will be a change in the logic chip. Next year it will be a change in the high bandwidth memory, right? Next year it will be a change in the networking protocol. So that is why this roadmap is laid out, because the final aspect of this is their customers and partners need to know this. People in Taiwan need to know this. All their hyperscale customers need to know this, because that is how they go and sign up for all these nuclear projects to make sure all those data centers are ready with all the cooling apparatus that is required. So that's why I think that it's a multi-year build out.
I wanted to leave a good chunk of time for Intel, another name you covered. But before we get there, you did note you see Nvidia generating, and I used to be an analyst, so I've never even seen a number like this before, $200 billion in free cash flow the next 2 years. That's a lot of cash. Like,
right.
What is Nvidia going to do? Is this company paying a dividend? Are they going out there buying other companies? That's a ton of cash.
Right. Of course. Look, if the company is able to, generate sales in the neighborhood of, 180 to 200 billion next year, and they are doing 45 to 50% free cash flow margins, essentially almost 45 to 50 cents of every dollar in revenue they're generating in cash.
Remarkable.
Right? Which is why, when you see sometimes people say, oh, Nvidia is trading at such a high multiple to sales, that is why it's expensive. What is misleading in that approach is when you compare it to other companies, they might be trading at a lower price to sales, but they're also generating much lower profitability. What good is having high sales if it is not translating into cash flow for the owners? That is why we look at earnings and cash flow multiples, because they tell the real story, as opposed to doing a lazy price to sales multiple, right? That doesn't tell you anything.
I hate
a company,
sales ratio.
Company can have a lot of sales but generate no profits.
True.
That doesn't make it cheap, right? On a price to sales. Okay. So when it comes to investments, I think that first of all, there is a big part of there is a part of this is going into dividend, right? It's a small part because this is not really a big dividend payer, but they do have a dividend, right? And they grow that. They do a lot of buybacks, but to be fair, some of those buybacks are to essentially offset the equity dilution when they hire all these very smart engineers, right? There's a lot of stock compensation expense. But what you also see them doing is invest a ton in the ecosystem. See, because it is going to take somebody with their heft who has the relationships in Silicon Valley, relationships with all the hyperscalers, relationships with all the enterprises, relationships with people in Taiwan, and then the interworking with the software community. And I think this is back to their roots, because when they started, it was really a gaming company. Now, when you're a gaming company and you're beholden to the company making the CPU, i.e. Intel, for your future, you have to be extra special, right? To be extra special, you have to work with game developers. You have to make sure that they know your roadmap, you know their roadmap, right? Much in advance. Now think about that, how that is so similar to what is being done today. Their roadmap is known to everyone developing software, right? Because it has come from that root of working closely. So no, I think that they are doing a ton of investments, right, around the ecosystem to make sure everyone is equally prepared and going at this together, because it doesn't help to just have all these shiny new pipes but nothing to put right on them.
You mentioned Intel. In the time we have left, we're not going to be able to unpack the whole Intel story, but Intel has really been struggling over the past few years. They're aggressively cutting costs, layoffs. What is the end game for Intel, and how important is it that to the country that they get whatever that end game is, that they get that correct?
Right. No, I think it is extremely important. They are one of the national champions, right? They are the creator of Moore's Law, right? It is extremely important that we have diversity in the supply chain, that we are not just, TSMC is an amazing company, but it is important that we have a choice, right? Because, with single source, right? And that too with a lot of production based in Asia, right? We are just opening ourselves to just unforeseen, risks and geopolitical factors. Having said that, where we fundamentally disagree with Intel's approach is the process of design and manufacturing are just two different things. The process of design, I always compare to running sprints, right? You're designing products, right, with a 1 year, 2 year cadence. The process of manufacturing is a completely different ballgame, right? Where you are investing over long periods of time, right? Very high capital intensity. It's a very services based model. So when you're trying to do both, you're essentially saying, what? I have the capability to go and compete with Nvidia and AMD and Broadcom on one side and TSMC on the other side, while I'm doing all these headcount reductions. And I'm 4 or 5 years behind. That is a tough act no matter who is there, right? So we think that the entire business structure is flawed. Until that business structure changes, right, I think it is very hard to see a path forward, because the designers are for the most part either beholden to manufacturing, or when they give product out like they're doing to TSMC, it keeps their manufacturing underutilized. Well, that's a problem. And the manufacturing side, because there is an inherent business conflict, they are not able to work with a lot of external customers. So we think it's a business structure problem.
I've covered CEO Pat Gelsinger's entire career, at least at Intel, and from day one, he's always wanted to, I think, manufacture, and he's put a lot of money behind this. Then, just listening to you, what do they stop the manufacturing? They just stop investing in that? That would be a major change in strategy.
Right. No, not at all. I think that there is absolutely a very important role for their design side, right? There is absolutely a very important role for their manufacturing side. Where we have right, our concerns is by trying to manage them and optimize, like the fancy way of saying it is by trying to, globally optimize, you're locally sub-optimizing, right? That these two things just do not, this whole IDM strategy, and it's not just us saying, look at where the industry is going. Look at what the smartest people, the most successful people in the industry are doing. They're either fabless or they're manufacturing. Companies in digital technology who have tried to go this integrated device and manufacturing IDM route, like Intel and also Samsung to some extent, are struggling, right? So the evidence is right there, right? It's not just us, having to speculate. The evidence is right there. So I think it's really a business model question. And look, the reason I still have hopes for a turnaround, and I wish for the turnaround at Intel, is they have a massive presence in the enterprise, right? Even after all the issues over the last 4 or 5 years, they're still selling 70 to 75% of all the PC and the server CPUs out there, right? When we had this recent malware attack on all the computers, it was Intel laptops with vPro that were able to be bought up very quickly, right? So it's an extremely important company in the ecosystem. Right? It has been what Nvidia is to generative AI. That is what they have been to that CPU market and PC and server. So I absolutely think that there is the potential for turnaround, but not in this current structure.
But do you see there's a breaking point coming here? Meaning that the layoffs have been severe. I mean, something's got to change. I mean, is something going to change within the next quarter?
It's tough. Look, one other metric is if you look at revenue per employee at Intel, even including the layoffs, it's about 450 to 500,000. At AMD, it is twice of that. At TSMC, it is over 1.2 million. At Nvidia, it's 4 million. Intel has more employees still versus AMD and TSMC put together.
Wow.
That's not, right, something that is sustainable, right? So that tells you there are things that are structurally that need to change here, right? But there is still a lot of assets. They have assets in FPGAs, right, with Altera. They have assets in automotive. They have other assets in manufacturing. I think it takes, but the issue they have is that the manufacturing side is not ready to compete, right? So one needs to create a structure for that manufacturing side to compete, and that's going to take time. It cannot be done in this structure.
I could spend all day thinking about this, but we are unfortunately out of time. You could really get lost covering Nvidia. I mean, in a good way. I mean, it's just a fascinating company at a fascinating time. Bank of America analyst Vivek, Arya, good to see you. Thank you for coming down here to the NASDAQ. It's very early, and we always appreciate your notes and you always coming on Yahoo Finance. We appreciate it.
Thank you, Brian. I appreciate it.
All right, that's it for the latest episode of Opening Bid. Please do hit us with those 5-star ratings on Spotify, those likes on YouTube, and share our content all over the place when going to Yahoo Finance. We'll talk to you soon.